Hello everyone. This is a course of Introduction to Accounting. In this chapter, we will learn more about the accounting cycle. We learn how to solve the receivable affect financial statement. So how payables affect financial statement, and also the other topic related to supplies, prepaid items, and another the new definition of the subclassified account. We call it the unearned service revenue. And finally, we will learn how to compute the depreciation expense and so how it affects financial statement. First we look at the definition between the cash and basic and accrual accounting, right? So the users of financial statement must distinguish between the term of recognition and realization. Recognition means the formally recorded an economic event, right? In big item or even in the financial statement. Realizations refers to collecting cash generated from the sales of products or services. User of cash. So the user of cash, a basic accounting recognize revenue and expenses when cash is paid or collected. In contrast, user of accrual in basic accounting recognize revenue when earned and expenses when incurred, regardless of when cash is exchanged. Virtually all of the major companies operating in the world are using accrual accounting, right? So now for the first learning objective, we'll show how receivables affect financial statement. So we have a first event, the company's Cactus consultant acquires 5,000 of cash by issuing common stock, right? So here is the effect of this transaction on the financial statement. On the model, we have a balance sheet asset equal liability plus stockholder equity. For the stockholder equity, we develop by the common stock and return earnings. So this kind of transaction increase the cash account for 5,000 and the common stock increase for 5,000, and this transaction is considered to be an asset source transaction. In the next column, you see the income statement horizontal. We have a revenue minus expense equals the net income. For this transaction, there's no effect to income statement. And finally, we have a cash flow of a financial statement activities that increase 5,000, or we call cash inflow. So now we look at our second transaction. The event number 2, during 2013, the Cato consultants provided 84,000 of consulting services to clients, but no cash has been collected. So this kind of transaction is frequently referred to as providing services on account. So what does it mean? It means that the client pays the company Cato consultant later, right? So here the company have we can see the new account assets. We call is accounts receivable. So for this transaction, the company increased the assets of account receivable for 84,000 because we received the revenue, so increase the company's returns retains earning of 84,000. It clarified as an unassessed source transaction, and because we receive money. So we look here, the revenue increase 84,000. It means that the increase the 84,000 of net income, but there's no cash transaction here, so we can mention that the cash flow is not available. Now we look at the transaction number 3. The companies collect 60,000 cash from customer in partial settlement of its accounts receivable. It means that now the client pay for 60,000, but they still owe 80,000, 84,000 minus 20,000. So it means that they still owing of so in this transaction increase the cash asset accounts and decrease the account receivable account. The income statement is not affected, but the statement of cash flow report an inflow of 60,000 for operating activity. It is classified as an asset exchange transaction. Even in the so here is here's the effect of this transaction on the financial statement model. Notice that this even affect the statement of cash flow since the cash was collected as a part of this transaction. So now we look at the transaction number 4. The company paid the instructor 10,000 cash for teaching training courses. It's a salaries expenses. Right? So this transaction decreases the cash assets and decreases the stockholders' equity. It means that the return earnings on the equity stockholders equity account. The salaries expenses reduce the net income, and the statement of cash flow reported as an outflow of cash for operating activity. This is classified as an asset use transaction. Even in accrual accounting, sometimes expenses are recorded at the time cash is paid, as long as it is the same time that the expense is incurred. Transaction number 5. The company paid 2,000 for advertising costs. The advertisement appeared in 2013. This transaction decreases the cash asset and decreases the the returning stockholders' equity account. The advertising expenses will decrease the net income. The statement of cash flows report an outflow for operating activity. This is also classified as an asset use transaction. And here is the effect of this transaction on the financial statement model. It means that for this transaction, when the company paid 2,000 for advertising costs, the cash outflows of operating activity decreased 2,000, return earning decreased 2,000 in the balance sheet, and the expense increase 2,000 and the net income decrease 2,000 in the income statement. So now we move to the part 2, the learning object 2, show how the payables affect financial statement. Look at the event number 7. At the end of 2013, Cato recorded accrued salary expense of 6,000. The salary expense is for the courses the instructor taught in 2013 that Cato will pay cash for in 2014. This event is a claim exchange transaction. The claim of creditor liabilities increase and the claim of stockholders' equity return earnings decrease. Total claim remain unchanged. The salary expense is recorded as in the income statement as expense. The statement of cash flow is not affected because it's recorded, right? So we have a salaries payable increase 6,000 and return earnings decrease 6,000. Here is the effect of this transaction on the financial statement model. And we can mention that this is a claim exchange transaction. Claim exchange transaction between the liability and the owner's stockholders' equity. So now accounts such as the last time we mentioned that the accounts that are closed like revenues, expenses and dividend are referred to a temporary accounts. These temporary accounts track financial results for a limited period of time of the company. On the other hand, on the opposite side, we have the balance sheet accounts like assets, liability, and equity are referred to abdominal accounts and they are not closed. The amounts in these accounts will carry forward into the next accounting period. So now we will look at let's review the step in the accounting cycle, right? First, we record all of the transactions during the accounting period. The second, at the end of the accounting period, we make any necessary adjusting entry to get the accounts balances up to date. Next, we prepare a financial statement for accounting period. And finally, we close the nominal or temporary account. So this is the first step in an accounting cycle. Now look at the learning objective 3. We will show how the supplies affect financial statement. So we look at event number 2. The Cato purchased 800 supply on account. So what does it mean, the supply? Supply, it means that the thing that the user to support for the office or anything that less than one accounting period, or the thing that the company will spending that less than 1 year, which is longer. The assets accounts, the supplies, and the liability accounts payable increase. Why? Because the companies purchased the supply with about amount of 800. So in this transaction, there's no cash transaction. So the company have to have a right to pay later, right? So the income statement is unaffected in this transaction. Expense recognition is deferred until the supply will be used. The statement of the cash flow is not affected also. So here is the effect of this transaction on the financial statement model, and we call this transaction is the asset source transaction. Now we will learn how to show the prepaid items in the financial statement. For this transaction on March 1st, 2014, the company Scato signed a 1-year lease agreement and paid $12,000 cash in advance to rent office space. The 1-year lease term begins the 1st of March. This transaction decreases the cash assets account but increases another asset, this prepaid rent. Therefore, it is classified as an asset exchange transaction. The prepaid rent is recorded as an asset but will become an expense later when it is used. The income statement is not effect to the income statement, but the statement of cash flows will report an outflow of $12,000 for operating activity. So here you can see the effect of this transaction on the financial statement model. Now we move to the learning objective number 5. We show how the unearned revenue affect financial statement. So, even number 4, Cato received 18,000 cash in advance from Westbury companies for consulting services to be performed over a 1-year period beginning June 1st, 2014. This transaction increases the cash asset account and increases a liability account called unearned revenue. Cato must defer or delay any revenue until it performs the consulting services for Westbury Company, so the income statement is not affected. The deferred or unearned revenue is a liability for Cato because it is obligated to perform the services in the future. The statement of cash flows reports an inflow of operating activity. This is classified as an asset source transaction. Now look at another transaction. For even number 5, Cato provided 96,400 of consulting service to its client, but no cash has been collected. This type of transaction is frequently referred to as providing services on account. This transaction increases the assets accounts receivable, and because of the revenue it incomes returns earnings the stockholders' equity account. It is classified as an asset source transaction. Accruals accounting requires companies to recognize the revenue in the period in which the work is done, regardless of when cash is collected. Here is the effect of this transaction on the financial statement model. Notice that the even effect on the balance sheet and the income statement, but not the statement of cash flow, since the cash was not collected as a part of this transaction. So now we look at the transaction number, another transaction, right? Transaction number 6, the customer collect 105,000 cash from customer in partial settlement of its accounts receivable. This transaction increases the cash asset account and decreases the account receivables asset account. The income statement is not affected, but the statement of cash flows reports an inflow of 105,000 inflow for operating activity. It is classified as an asset exchange transaction. Here is the effect of this transaction on the financial statement model. Notice that this even affects the financial statement of cash flow, since the cash was collected as a part of this transaction. Now transaction number 7, the company paid 32,000 cash for salaries expense. This transaction decreases the cash assets account and decreases the retained earnings stockholders equity account. The salaries expense reduces the net incomes and the statement of cash flows reports an outflow of 32,000 for outflow for operating activity. This is classified as asset use transaction. So here is the effect of this transaction on the financial statement model. Now transaction number 8, right? These companies incur 21,000 of other operating expenses on account. So incur, it means that they have an operating expense but they didn't pay, right? So these transactions increase on one claim account, they call this liability accounts payables. A liability account is also decreases others. Decreases another claim account is retained earnings of stockholder equity account. The expenses decreases the net income, so we have a net income decrease of 21,000. It does not affect on the cash flow. It is classified as a claims exchange transaction. So transaction number 9, the company paid 18,200 cash in partial settlement of accounts payable. So this transaction decreases the cash assets account and decrease liability accounts payable accounts for the same amount of 18,200. And you see that there's a cash decrease, account payable decrease. There's no effect on the income statement, but the statement of cash flows reports an outflow of 18,200 for operating activity, and this is classified as assets use transaction. So here you can see the effect of this transaction on the financial statement model. The first is the balance sheet, the second is the income statement and the statement of cash flow. look at another transaction number 10. The company paid 79,900 for land it planned to use in the future as a building site for its home office. So it means that the company's this transaction purchase is purchasing land, which case is an asset exchange transaction. The income statement is not affected. It is classified as an investing activity that affects to the cash flows cash outflow for investing activity of 79,500. And here you can see the effect of this transaction on the financial statement model. Okay, so now we look at continue with the transaction number 11. Company paid 21,000 in cash dividend to its stockholder, right? So the payment of dividends decreases the cash assets account and decreases the retained earnings stockholders equity account. However, it does not affect the net income statement, but the cash flow of financial activities reports an outflow of 21,000. So here you can see the effect of this transaction on the financial statement model. Transaction number 12, the companies acquired 2,000 cash from issuing additional shares of common stocks. Right? So this transaction have increases the assets, the cash asset account of 2,000. It also increases the common stocks stockholders equity account of 2,000. There's no effect on the income statement, but the cash flows shows the cash inflow of 2,000 for the financing activity, and since the transaction is classified as asset swap transaction. Now we look at another transaction. After determining through a physical count that it have 150 unused supply on hand as of December 13, the company recognized the supplies expense. So you know that at the beginning the company have beginning supplies balance is 0. They purchase 800 and the supplies available for you equal 800. At the ending, they found there's 100 left. It means that the company used $650 of expense. So the company would find it impractical to record expense each time an individual supply is used. Instead, they record supplies expense at the end of the year by determining the total quantity of supply used. To calculate the quantity of the supply used and together the beginning supply balance and supply purchase for determining the supply available for use, then they abstract the supply ending and you have a supply used. So the company have a supply asset decrease use 650, and that's the transaction effect to the return earnings decreases of the same amount 650, and this transaction also effect on income statement because there's an increase of expenses of supply and the net income, but there's no transaction or no records on cash flow. This transaction is classified as asset use transaction. So now we have transaction number 14. The company recognize the rent expense for the office space used during the accounting period. The record that the Cato paid 12,000 on March of 2014 to rent office space for 1 year. So see the event number 2. Between March 1st and December 31st, the company has a U10 of the 12 months rent. Therefore, the company have to recognize 10,000 of rent expense and reduce the prepaid rent at 10,000. It is classified as asset use transaction. Here is the effect of this transaction on the financial statement. So we have expense of the rent is 10,000 that affects the net income and effect to the retained earnings. No recording for the cash flow. Transaction number 15. The companies recognize a portion of unearned revenue it earned during the accounting period. Recall that the Cato receives 18,000 cash in advance from Westbury Company to provide consulting service from June 1st, 2014 to May 31st, 2015. See event number 3. By December 13, Cato have earned 7 months of revenue continuously as it performs consulting services. Cato can simply recognize the amount earned in a single adjustment to accounting records at the end of accounting period. Cato can recognize the revenue for 7 part of 12 of the 18,000 or 10,500 because the liability account decreases and an equity account increases. It is classified as a claim exchange transaction. Like as a year-end adjustment, it does not affect the settlement of cash flow. So now look at the transaction number 16. The company recognized the 4,000 accrued salary expense. Accrual accounting requires company to recognize the expenses when they are incurred, regardless of when they are paid. Cato must recognize the salary expense in the year that instructor performs the work, even though the payment will not be made until 2014. The adjusting entry affect the balance sheet by increasing the salaries accounts payable, but also decrease the retained earnings stockholder equities account. It is a claim exchange transaction. The salary expense will decrease the net income, but there's no effect on the cash flow transaction. So now we look at the section number 2. We will show how the difference affect financial statement. For this advice, our learning objective, we will classify the accounting even into one of 4 categories: asset source, asset user, asset exchange, and claims exchange. Also, the business engage in an infinite number of different transactions. All transactions fall into one of 4 types, which includes the asset source transaction, asset user transaction, asset exchange transaction, and claims exchange. Increase one claim account, decrease another. For learning objective number 7, we learn how to compute the depreciation expense and show how it affects the financial statement. So we will use the method we call it estimating straight line depreciation to measure the net economic benefit of running a business. Assume that the Libby company uses a forklift and must estimate how much of the cost of the forklift is used in the process of earning revenue. If the forklift has a 4-year useful life and 3,000 salvage value and the cost of 43,000 when purchased, it is logical to allocate an equal amount of 40,000 difference between the asset cost and minus the salvage value divided by 4. It means that equal 10,000 per year for when the equipment is used. Recognizing the depreciation expense is an asset use transaction. Asset and equities decrease. Asset and equity decrease. On the income statement, expense increase and net income also decreases. Uh, There's no cash flows consequences. Recall that the cash outflows occur at the time the asset was purchased. There is no cash flow when the expense is recognized. So in this transaction, you can see another new asset account we call this accumulated depreciation. This is quota assets account. It means that it increase when this account increase, it decrease the asset account. So in this chapter, to conclude, we learn more about the accrual basic accounting and the accounting cycle. We also learn about how corporate governance and fundamental of the companies inside of this topic. Thank you and see you in the next presentation. And I hope that, and if you have any question, please do not hesitate to